afternoon. We're ready to begin our webinar titled Retirement Plan Options for Small Businesses. Before I introduce our guest expert, let me remind you this webinar is a presentation of the Community Economic Development Fund in Meriden, Connecticut. I'm Frederick Welk, a business advisor for CEDF clients. The Community Economic Development Fund is a nonprofit organization which provides enterprises in Connecticut with term loans, lines of credit, and commercial mortgages when they can't get traditional bank financing. We welcome our webinar participants who include CEDF clients and business owners from across Connecticut. For practicality and to improve the program quality, we're muting the lines of everyone tuned in. If you develop questions, please use the Q&A button at the bottom of your screen, and we'll get to as many of the questions as the hour permits. The presentation is being recorded, and CEDF will make the program available on our educational website in the coming days. You'll find it, along with much more small business-related content, at weteachsuccess.org/replays. The launch of MyCT Savings last year by the State Controller's Office added a new spotlight on the importance of retirement planning, as well as a mandate for Connecticut employers with 5 or more employees. But the state program is not your only option as a business owner. Today, we'll learn more about small business retirement plan alternatives and how they can help you retain your best employees and compete for new ones while showing your support for your staff's long-term concerns and potentially realizing tax savings for you as the owner. Jenny DeRosa Bergeron is the founding member of Athene Wealth Management, 5-time 5-star Wealth Manager Award recipient. Jenny specializes in pre- and post-retirement planning, education planning, employee retirement plans, and insurance strategies. After graduating Phi Beta Kappa with her bachelor's degree from Trinity College, Jenny obtained her Series 7 and 66 securities licenses, plus her health, accident, and long-term care insurance licenses. Welcome, Jenny. Glad to have you back.
Thanks. I always enjoy these days. So I wanted to welcome everyone. I work with many small business owners, small to medium-sized business owners, and retirement plan options is very, very stressful for them, especially in the first 5 years of business. So maybe people can relate. Cash flow, profitability, that all comes into play, and they're always afraid that they can't do something for themselves, let alone employees that they usually don't have in the beginning. So I said to Fred, this is really a good topic for us to go over, because a lot of it is just peace of mind for folks that are in the early stages of their business or always struggling to put away for themselves. So, retirement is going to happen, whether we believe it is or not. We are going to get to a point where we're not going to want to work anymore, or we can't work, right? There are many fairly painless options to offer retirement plans, not just for yourself, but for your employees. And, studies show, AARP did a recent study that only 1 in 4 small business owners offer a 401k, although you'll see that there's other options. And, over half of business owners feel that they can't. They're afraid that they won't have the money to do it, not only for themselves, but about 38% plus feel that they're not going to have enough money to make the match, right? So there's many reasons to offer a retirement plan. Really, the first one is to save and invest for yourself, because as I said, there's going to come a day where you're going to need to live, and you're not going to be getting, W-2, 1099, LLC, whatever that income is. And Social Security, that we'll talk about in a little bit, isn't going to be everything for your retirement. So a retirement plan of some sort helps retain existing employees, attract new ones. Even when people are left to their own devices, they come to a financial advisor like myself, or they're a DIYer. It's very hard to create that habit. So this gives them something that they can, easily sign up for. It offers support, again, for the employees as they plan for their futures and yourself, and offers tax benefits. So you're going to get tax benefits from putting money into a retirement plan for yourself. It's going to defer your taxes, reduce your taxable income. It's also going to have tax benefits as an employer, but for your employees, it's going to reduce their taxable income if they do a post-tax contribution and help them prepare. So, there's been less certainty surrounding Social Security. Some of that, I like to say is blah, 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 but, we'll talk about that. So, there are often news stories about how the trust fund, basically what is going to be paid out is going to be, some people think that it's going to be exhausted in 2035. Well, not so. It's basically just that the money that's going in from people who are working and any income that's generated off that trust fund is calculated out to be able to cover about 80% of all Social Security going out. There are definitely some things that can be done. So right now you can take Social Security if you don't have a disability or you're a qualifying widow, because there's always parameters about when and how you can take Social Security. You can take it as early as 62. You could take it at what Social Security calls full retirement age, which is not 65. People often confuse that with Social Security. I'm sorry, Medicare. 65 is the age for Medicare. Full retirement age for Social Security, for someone like me who was born in 1968, if it's 1960 or later, your full retirement age is 67. For some people, it's 66 and 6 months, 66 and 4 months. You don't have to pull your Social Security, at a particular age. Just know that if you pull it before your full retirement age is defined by Social Security, that you will definitely take a haircut. It's about a 30% reduction in benefits. And if you leave it until you're 70, it will continue to grow. The old statistic is that if you had that money in an investment strategy, it would be equal to an 8% return every year. So the general rule of thumb, if you're not working with, a financial advisor who's doing a financial plan or anything like that, the general rule of thumb I tell people is if you're not in a critical, financial event or a medical event and you don't need the money, don't take it, right? If you're working, wait until you're 70 and just let it cook, because compounding really, really does matter. When I do financial plans for people and we look at different ages for them to take their Social Security, it always looks better when they wait, because again, it's just simply compounding. So every year, or most every year, unless we're in a bad recession year like 08, the government is going to give a cost of living increase on Social Security. So think about it as a snowball, right? You roll it in more snow, it's going to get better. So if you wait till you're older, because you have other forms of income, whether you're working or you have a non-IRA account, or you have other monies that are coming in, you will then start your Social Security at a larger amount, which will increase starting from a larger amount. And it puts less pressure on your assets that you might be taking money out to live on. So again, Social Security, always a big question. Have someone do a financial plan, make sure you know when it's the right time to take it. There's also income parameters. If you're working and you're under full retirement age, there's a certain cap. I've got my notes there. I think it's around 19,000 this year. If you were going to take it and you were 62, if you made more than that, basically you're going to pay money back or you're not going to be eligible, right? So another reason to have other savings other than Social Security. People are living longer, and we're living healthier lives. So another good reason to put away for retirement. When I do my planning, I project people living out to the age of 93. The funny thing is people will say, oh my gosh, I'm not going to live that long, or put me out on an ice floe. They joke about that. But I got to tell you, people are driving, they're living fruitful lives, regardless of genetics in many cases, into their 90s. So you're going to want to prepare for that longer time span. And then there's inflation. It's good to have liquid cash. There are fundamental rules about what you should have for liquid cash. In retirement, at a minimum, it's great to have liquid cash that equals a year up to your annual, a year of expenses. But, some people say, I'm going to keep everything in cash or under the bed in a mason jar, whatever that is. But you're not going to keep pace with inflation. And we really saw that in the past few years, because we had been in a period of low inflation for such a long time. So again, we look at retirement savings as a three-legged stool. Social Security, which we've talked about, retirement plans, which we'll dive into a little bit more, and then personal savings, okay? So these plans can make a crucial difference. There's definitely plans other than a 401k, which we'll talk about, and they're very simple, and many of them, you know, are easy to maintain. They don't have arduous filing requirements. You don't have to have a third-party administrator, etc. So the three main ones that I'm going to be talking about are a SEP IRA, a simplified employee pension, a simple IRA, savings incentive match plan, and a 401k, okay? So the SEP IRA was created by Congress in 1978. It's very simple to set up and administer. There's no annual reporting required. So you open up a SEP IRA, you work with your financial advisor and your accountant to determine what you can put in. You must include most employees, even part-time workers, and only the employer makes contributions. So with a SEP, even part-time employees are included. And with only the employer making contributions, you want to figure that into your cash flow, because if you have 5 employees, you want to make sure, and there's calculations around if you're putting in so much for yourself and it's a percentage, the max is 25% of your net, right? You've got to put the same percentage in for your employees. So most of my clients with a SEP, we work with their accountant right off the bat. They know what their standard income is. Granted, with businesses, it can fluctuate. And sometimes people will put money in a little bit throughout the year, but many people with SEPs are just putting money in when they file their taxes. That's the deadline. And that deadline can even include extensions. So if you go on extension and your taxes aren't filed until July or October, you don't have to put the money in for yourself until then, or your employees. So again, contributions are up to 25% of employee compensation, and there's a max on that that's determined every year by the IRS. In 2024, it's $69,000, so it's whichever is less. Contributions must be in cash. It can't be assets or property, and RMDs apply. So let me explain that. With a SEP and like a simple, if you are RMD age, which for years was 70 and a half, you had to take out a required minimum distribution. That is calculated using the balance in the account, which is December 31st of the prior year, and then life tables that the IRS puts together. And there's a required amount that you have to take out every year. So even if you're still working in this business or at a company and they offer a SEP or a simple, and you are RMD age, which again, used to be 70 and a half. So for those people that were under that rule, it continues. In 2024, it's age 73. And if for people that are born after 1960, it's 75. So if you're working in this business and you have a SEP, you do have to take the RMDs out at that age. So you're still working, you still have your SEP, you're still having contributions put in, they're still being invested, but money does have to come out. What most of my clients do is they're not using the money, so they take some taxes off the top. Some goes to the feds, some goes to the state. If they're in a state that has income taxes, they get the net and they reinvest it. Some people put it in grandkids' 529s, or they put it into a taxable account. Some move it from a taxable account to a Roth. My point is that you can keep investing it, right? Or just use it. So if you don't take your RMD by December 31st of the year you're supposed to take it, there is a penalty. It used to be 50%. So let's say that your RMD was $3,000 and you didn't take it. You're going to get penalized 50% of that. But there was a new law that went through called the Secure Act, which decreased that penalty to 25%. Either way, you want to make sure you're taking your RMDs. So with a SEP, you and your employees will manage their investments. So the SEP money will go to whatever financial institution you're doing business with. For your employees, you can make the contribution. It could go to their financial advisor if they're not using the same one you're using, and they manage their investments. There has to be, as I said, uniformity required in contributions. So this is where, again, with my clients, I say, get your accountant involved. Don't try to do it yourself. So let's just look at some net salary examples to see what the maximum contribution would be, okay? So if we look at someone who's making $20,000 a year and we're working off of the 25% number, it could be 8% one year, it could be 20% one year. So if you're having a tighter year for cash flow, you don't always have to do that 25%. So again, there's some nice flexibility there. So if someone's making 20,000, one of your employees or yourself, you netted 20K, it was a rough year, it was maybe your first 2 years in business, your maximum contribution at 25% would be 5 grand. If it's 28,000, it would be 7. So it's good to see these examples because many employers, as I mentioned, business owners, get really worried about cash flow. Now look at someone whose net, maybe it was the business owner, made 300,000. 25% of that would be over the 69,000. So you would put in the cap, which is 69,000, because again, the rule is up to 25% of annual net compensation or 69,000, whichever is less. So then we've got a simple IRA. I have a lot of solopreneurs and LLC people with employees that tend to do the simple IRA over the SEP. With the simple IRA, there's a smaller amount of money that you can max it at. It's nowhere near 69,000 if you're going to do the max. But some business owners, employers, whether they have employees or not, don't want to be bothered with dealing with the calculation. So they just do the simple IRA. Or even if they're profitable and they run a successful business, they know they're not going to have $69,000 a year to put in. So they start with the simple. They can open up a SEP later if they're able to go over what the simple allows. Just as long as you don't have a simple and a SEP open at the same time. So if you had a simple, it's basically got to be stopped or disbanded before you can contribute to the SEP. Now you can have a SEP or a simple and a 401k. So how would that happen? Many people have their own businesses. They're making money. They're working in that business. So they have a SEP or a simple, but they also have work they do for another person and they offer a 401k. You could contribute to all of them as long as you don't go over the max for what the 401k allows, okay? So with the simple IRA, you have to have 100 or fewer employees. So if you have a simple and you're at 100 employees or more, you have to move to a 401k. Your employees have to be earning at least $5,000 a year, businesses with no other retirement plan. There's 2 ways to offer a match or a contribution on a simple IRA. So a simple IRA, like a SEP, is very easy. People manage their own investments, and most simples are what we call a 5304. So if your employee isn't working with the same financial institution you've opened your simple with, they can put their simple contributions with their financial advisor or to something they manage on their own, like a Fidelity or a Vanguard. They determine what they want to put in, and then you can do a match or a non-elective contribution. So if you do a match, it's a max of 3%. You can never do more than 3%. You can also start out at 1%, and that's really good for new business owners or people who aren't that profitable or just get nervous. So if you do the 1% match, you will match them up to 1%. And you can put the match in just like a SEP when you do your taxes. And if you're on extension, you can hold that until you've done your taxes, July, October, whatever it is. You can also put that match in throughout the year. Many employers do that so they don't get stuck having to write a big check at the end of the year. The contributions, if they're done on a pre-tax side, will reduce taxable income, be tax deferred. And you'll also have a benefit, a tax benefit as an employer for offering a match for your employees. So if you do the 1%, you can do that for 2 years, but then in the third year, by IRS rules, you have to go to 3%, okay? But that's on a 5-year rolling. So if you do 1% for 2 years and then in the third year you go to 3%, if in year 6 you're struggling, you can go back to 1% for 2 years, but the same rules apply. Then in the third year, you have to go to 3%. Most employers either start at a 3% match or they do the 1%, they go to 3% and they stay there. But just so you know, you can change it. So if your employee puts in 3%, and then you're going to match them 3%. It's 3% of their salary, right? It's not 3% of what they put in. So if they put in 10%, you're only doing 3% or 1% if that's what you chose, okay? With the simple, just like a SEP, people are automatically vested. So that means that if they, and you offer these plans and then they leave within a year, they take all the money they put in and all the money you put in. With 401ks, you can have vesting options. So maybe someone has to stay there for 6 years before they get all of the money you put in. Now, with the SEP and the simple, there are, max restrictions. So they exclude union employees and non-resident aliens. Most people are excluding that. Some people with a simple and with a SEP 2 will have people, employees be automatically from day one eligible. Sometimes you can write it up where they're not eligible for 90 days. Just know that there's some flexibility there and you want to work with your advisor or your tax professional to, determine what's going to work best for you. So with a simple, who's going to qualify? Someone who's at least 21 years old. And these are the more restrictive requirements. They have 2 years of service before the current plan year, and they meet salary requirements that they've earned at least $5,000 during any of the 2 preceding years. And they're expected to earn at least $5,000 during the current plan year. So if you know that you have a higher level administrative person that's going to be working for you and you want to offer it right away, but you've hired them in December, you can, have the simple with less restrictive terms if you know that's kind of how your business flows. And again, the employer must have no more than 100 employees. So let's look at some examples. So your employee earns $25,000 a year, okay? So if you're doing a match, and I'm going to talk about the non-elective contribution in a second. Your employee didn't put anything in. Well, you put nothing in, okay? Your employee put in $250. You put $250 in. Your employee put in $2,000. Well, 3% is not going to be $2,000. You're putting in $750 because that's $2,000, and so on and so forth, okay? Now, if you choose to do a 2% non-elective contribution for a simple, that's very similar to the SEP in the sense that your employee does not have to participate, meaning they don't have to put money in. So typically, employers who are offering a simple are doing the match because they're thinking if the employee is deciding not to put away for themselves, they don't have skin in the game, I'm not going to put anything in. Otherwise, they would just offer the SEP where the employee doesn't ever add to it and it's just the employer. So for, this is a nice example for the 2%, the non-elective, okay? So your employee's annual compensation is 25,000, you're going to give them 500, right? Your employee's annual compensation is 125,000, you're going to give them 2,500. If you have someone that is making, a good amount of money, and it'll go up to 6,600 for 330,000. And again, RMD rules apply to the simple. So if you're offering a simple and that person is RMD age, let's say it's 73, it's this year, they do have to pull RMDs out, but it doesn't mean that the plan gets shut down. You can also offer profit sharing plans, and a lot of people like to do this because it's sharing the wealth, and it's exactly how it sounds. They're sharing a portion of the profit. It's flexible, it's discretionary contributions. You don't have to do it every year. May be a good fit for people with, fluctuating profits. Again, another way to help retain and attract talent. It includes employees who are 21 and have worked 1,000 hours or more during a plan year. Now, there are some new rules that came down the pike from the Secure Act, which include long-term part-time employees, those you want to work with a third-party administrator on, and they don't become effective until 2025, so I'm not going to go too into the weeds on that. They're more complex than a SEP or simple. You're definitely going to want to work with a third-party administrator on that. There's going to be filings for that. And just like a 401k, you can open up a 401k, and that 401k, it's going to be more complex. When you open up a 401k, it's typically going to be, it's managed by, say, a company like American Funds or ADP or Emeritus. You can have a financial advisor. So that person like me would work to educate your employees, help you with the paperwork, help you get it open, help you if you have problems with the online portal, really be an intermediary and be someone who educates your employees and yourself about the investment platform, right? Then you have the third-party administrator who essentially is going to make sure that the plan is legal and compliant. And then you're going to have the record keeper who's going to, the statements, the online portal, the payroll connection, that's all going to be through that person. Again, like an ADP, American Funds, Emeritus. There's going to be typically a finite amount of investments that you can invest in. So for example, only mutual funds, and the record keeper who puts that together, the third-party administrator, the financial advisor can all work together to help you with that. Maybe it's a suite of 20 funds. You could have a plan, because there's varying degrees of these plans, where you match or you don't match. Not all 401ks you have to match. With some 401k plans, you could keep it simple. You can match 3%, or you could match 3% and then up to 6%, but after 3%, it's 50%, right? Up to 6%. You can get very complicated there. You could have your employees put in on a pre-tax basis, or they could put in on a Roth basis, which is after taxes. So with the Secure Act of 2.0, and it's taken a long time for the IRS to get their final rulings out on that and get their paperwork together. But with the Simple IRA as well, people can also put in on a Roth basis if the employer is choosing to do so. So you may have a 401k plan as well that doesn't offer you the ability to put in on a Roth basis, just pre-tax. But just know that there's a lot of different features because of the Secure Act, and they weren't all readily available, say, in 2023 or 2024. There's going to be savers components to 401ks. There's going to be an option if your employer chooses where their match can go toward paying student loans and things like that. So you can set this up again with varying degrees of eligibility. So maybe someone can't be eligible for a full year. Maybe there's those vesting rules where people are immediately vested, or you want a 5-year vesting where they have to work a full 5 years. And if they leave the company, they can only take, or they can take all of their money they put in always, but they have to be there for a full 5 years to take all of your money that you put in. So some employers do that for retention. Again, employee contributions, but they're not required. Some plans will allow for an automatic contribution, where if the employee is there, automatically 3% is going to be contributed, but you don't have to do that. Some plans will allow for the employee to have to go on to the portal or work with someone to determine how they want their money invested, or they could have the type of plan where if your employee doesn't choose the investment, they're just going to go into like a target date or a lifestyle fund. And so that's based off of their age. Typically, they use 65 as a retirement age. So if they're 35, they're going to assume they're going to retire at 30, and they're going to come up with, a stated mix. Maybe it's a moderate portfolio. So some equities, some fixed income that they go into. So it's not all equities. Maybe it would be all equities if they didn't choose a fund, and the lifestyle fund, let's say they were 20 or 21. Maybe that would be a more aggressive portfolio if you did the type of plan where if they didn't choose an investment, they would automatically go into a lifestyle fund. It's maybe more appropriate for companies with 30 or more employees, but typically a 401k is appropriate based upon how the employer wants to put in. So if you have a profit sharing component, you could have a max of $69,000 a year that could go in. If you're under 50, it could be, 30,500, right? If you're 50 or older, I'm sorry, 30,500, because the simple plan and the 401k, they have catch-up contributions for people that are 50 or older. So with the 401k, the catch-up contribution is 7,500. So if you're older, they allow catch-up contributions. So let's just look at an example for a 401k. So for a business owner making $250,000 a year, and they're putting in $23,000, your non-elective contribution is $12,500. That's for a SEP. Okay. The total is going to be $35,500. So let's just say you have a key employee making $80,000 a year. The employee's annual contribution is $8,000. There's a non-elective contribution of $4,000, right? You have an employee making $25,000, so they put in $2,500. Again, your contribution is $1,250. So again, these examples are important because when people are thinking about opening up these plans, they get very, very scared about if they're going to be able to put the contributions in. So I find that when you're starting out, the SEP IRA is great for people that don't have any employees, because they really don't want to make contributions for people that they're not mandated to make contributions for. So it's just themselves. They're starting out, they say, this is great, I could put 69,000 in if I really have a bang up year. But if not, they don't have to put anything in. They could do 10%, they could do 2%, they could do 25%. For people that start to have employees, they usually foray into the simple IRA because they figure if someone's not going to participate, I don't want to be on the hook to make a match. Most people do the match versus the non-elective contribution. The people who want to do the non-elective contribution that have employees usually open up the SEP. The profit sharing, I typically only see that for people that have a 401k and they add the profit sharing on. Again, it's a nice incentive, but it allows them, first and foremost, as an employer, to be able to max out at 69K. And if they're able to do that, then they're typically able to do that for employees that are putting a lot in, and if they have profit. The 401k is also available. It's called a solo K or a KEO or an owner K for people that don't have employees, but they're starting to make a lot of money and they want to have that 69,000. They want to have that higher limit. And if it's under $250,000 until the plan equals $250,000, meaning they don't have that much in their account, they don't have to have a TPA or a third-party administrator to manage it, which is nice because then they won't incur fees for that reporting we're talking about, having someone do what's called a 5500, having them do a census every year, which is a lot of paperwork that the TPA does to make sure that the 401k is compliant and is legal, right? And is following all the rules. So if you have the option of being very profitable and putting money away, you might want to start with a solo or owner K. And those also tend not to be managed by the larger companies like Emeritus, ADP, Fidelity, et cetera, where you have a finite amount of investments that you have to go into. So many of those you're working with an individual advisor. So you have a full suite of investments like a simple or a SEP. So you can go into individual stocks, individual bonds, CDs for your fixed income if you choose. So they offer some flexibility there. So from an investment perspective, the 401k plans tend to offer, it's not that they don't have appropriate investment choices, but you're really not going to see the ability to do individual stocks, individual corporate bonds, CDs, things like that. It's really going to be more mutual funds. So again, you're going to want to look at what's going to be the most flexible for you. Reducing your taxable income for yourself and your employees and getting a tax benefit for matching is always going to be key. Number of employees you want to look at. If you're under 100, you know, some people don't even bother ever looking at the 401k. 401ks you can do, but you don't have to match. Simple, you're going to have to match if you have employees. So again, those are all things you're going to want to look at. The simple has, you know, they all have deadlines as to when you can establish them. So the 401ks, you know, typically before the end of the year to be effective for the next year. The simple, it's the October timeframe to be effective for the next year. So you're going to want to take that into account. Some people use just a traditional IRA to put money away for themselves, but you're going to be capped. If it's 50 and over, it's 8K this year. So some people still use the traditional IRA as a way for them to put money away for retirement. They don't have employees yet, and it's really all they can put away, and that's fine. But again, to attract and retain talent, to attract and retain talent, to save for the future. Again, with inflation, you don't want to just be putting money in the bank or under the bed, and you also want to make sure that you're saving for retirement. So it's better to start now versus later, no matter what age you are. If you're young, that's great. Time is on your side. We know in the market, it's not timing the market, it's time in the market. But for some people that maybe started their business later, 40s, 50s, they feel they're behind the 8 ball. I always tell people 0 + 1 is better than 0 + 0, you know? So I like to always give an example. If you say, let's have a goal of saving, you know, $500,000 by the time I'm 65. So the earlier you start, the better. So let's look at an average, just an average over the time period of you've been investing, some years up, some years down, an average of 8%, which is a growth-oriented portfolio, compounded monthly, and a tax-deferred investment. So a 401k is simple, a SEP. You could even use an IRA. No early withdrawals, right? And all withdrawals would be after retirement. So this money would be in here and it would be cooking until you're 65. So if you were putting money in starting at the age of 25, you'd want to put in $142 a month. So, let's do some math, right? that would be $1,704 a year, roughly $1,700 a year. That is not a lot of money, okay? If you start at the age of 35, $333 a month. If you waited until you were 55, you would have to put in over $26,000 a year to get to that goal of $500,000 by the age you were 65 and have an average return of 8%, which, you know, before COVID in our ugly bear market of 2022, we had a nice bull market, but we know that recessions come, corrections come, bear markets, 25% or more drop in a short period of time come. So the sooner you can start, the better, and doing anything is better than doing nothing. So, you know, you want to really start to prepare yourself as soon as you can. And, you know, if you have any questions, I'm happy to help. Work with a tax professional, and especially when it comes to Social Security, definitely make sure that you are, you know, doing a plan and making sure that you are not just, like I say, throwing spaghetti against the wall, because it's really the worst thing to do.
Let's make sure it's sticky spaghetti if you must do that.
Yeah.
Let's remind everyone to use the Q&A feature at the bottom of the screen if you have questions for Jenny, and I certainly have some that came up during your presentation. And Jenny, you earn your dollars every day with the complexity of all of the plans and nuances of planning. So we're
Yes.
very grateful to have you here. You sent me a handout the other day,
Yes.
which we can make available on the program screen after this episode is posted. Tell us about the handout and what's useful with that.
So with the handout, it's going to give you the basics of what I talked about for the comparisons for the simple, the SEP, and the 401k. So that way you can use it as a guide for when you are, you know, trying to determine what the best choice is for you. It will also give you some of the maxes. So again, I talked about the 69,000 for the profit share. I talked about the 69,000 for the SEP. For the simple IRA, we've got $16,000 a year for people who are 50 and under. And then we've got a catch-up contribution of $3,500 for people who are 50 or older. So you want to keep that in mind. Some people like to kind of gauge that. For the 401k plan, again, if it's got a profit share, 69,000 is going to be your max. For 2024, the max is 23,500 again for people who are under 50. But if you're 50 or over in that year, you can add an additional 7,500. So it has some of that data in there.
Yeah, so that'll be useful. And again, people can download that from our program page, and all of the participants will be notified when we get this episode posted.
Right.
Now, you mentioned the life tables and the fact that you use 93 for planning. Is that because the IRS has us optimistically lasting till 93 years old from what age?
No, they don't. In fact, I haven't looked at the average life expectancy since after COVID. At one point, it was in the 80s, then it dropped down into the 70s. And one of the reasons for that was really suicide and drug addiction, you know, overdoses, pretty sad. So it may have increased a little bit. I use 93 because of what I see. I see, you know, clients coming in their late 80s. They're running around, they're playing golf. Yes, they've slowed down. And then, you know, you see clients that are in their early 90s. They're maybe not traveling as much, but I'm definitely seeing people living longer. So my feeling is, let's plan to see how long we can get your money to stretch. And God forbid you pass away before 93. Now you've got money that you can pass on to heirs, although most of my clients understandably say, I want to spend every penny. Or you can have a cushion. So I'm always going to be a proponent of, say, long-term care insurance or something that can help you if you have a critical medical event, but it doesn't always cover everything, or some people don't have the foresight or the ability to get underwritten to do that. So then you have a cushion. And that cushion could be used for good, bad, or indifferent, right? You know, travel around the world, etc.
Okay,
Yeah.
starting to have some questions coming in here as we give people time to type in what's on their mind. I've got a kind of a philosophical question for you.
Okay.
So we talked a lot about minimum contributions from employers and the reluctance that new businesses especially have with that. Isn't this really just a matter of doing kind of total compensation planning for the workforce? Because in reality, this kind of a zero-sum game, isn't it? That there's a certain amount that an employer can devote to compensation, and it comes in different forms. You know, it might be health insurance, it might be retirement, it might be wages. And some employers may just want to, how would you say, keep it real simple and just pay a more generous salary, but there aren't those tax benefits that you were talking about.
Right, absolutely. So besides the tax benefits, it does make a more attractive total compensation package. The other thing is 5 employees or more, and we talked about this, Fred, before the seminar. You know, you are included, the business owners are included in that 5 or more to then have to offer the mandatory Connecticut Retirement Savings Plan. And sure, it's great that you have that opportunity, but most people don't want to have to do something. They want to be able to do it with their flexibility in their terms. So these options are already out there. They've been out there for eons, you know? So why not have control, be able to talk to someone to find out what's going to work for you? I know for me, not every financial professional works the same way. But for my clients, I get what we call, you know, a permission to disclose information and talk to someone's tax professional. I make those calls. I weed through all the heavy stuff for my clients so that we can decide what the best plan is for them. And then we move ahead. So yes, definitely total compensation, but it's having choice, and when you make the decision, that's 80% of the battle, making the decision to do it.
I guess we should maybe directly comment on
Yes.
these plans being substitutes and acceptable compliant substitutes for the MyCT savings.
Right.
How does that work?
Right. So with the MyCT savings, the people that I work with are all doing their own stuff, obviously. Although I do have one client whose in-law did the MyCT savings. I am not under the impression, I'm not really sure if I'm understanding that you can do both. Is that what you were asking?
Yeah, I think our participants need clarity on whether you
Maybe.
have to do both as an example.
Yeah. So if you offer your own plan, you then do not have to do anything with MyCT savings. So there were many clients that I opened up simples or 401ks for when we knew MyCT savings was coming down the pike, because they wanted their own plan, they wanted their own choice, all the things that come with that. And it basically gave them the impetus to finally get off the pot and do something. They knew they were going to do something eventually, but it's kind of like your estate plan. It's always easy to just put it on the back burner, right? So if you have your own plan, you don't have to do MyCT savings. If you're doing MyCT savings and you want to look at doing another plan, you absolutely can. My assumption, but I would have to do the research, would be just like anything else, that you could start a new plan, SEP Simple 401k, and then put the kibosh on the MyCT, because that's how it is in the open market. If you do a SEP and you go to a simple, you just stop the SEP and do the simple. If you do a simple and for whatever reason you choose to go to a 401k, you disband the simple and you go to the 401. Does that make sense?
Surely, and I'm
Yeah.
sure a call to the MyCT savings office will clear up whatever requirements or processes there are for doing what you just said.
Right. And I do have one Q&A here from Christine.
Mhm.
So what I'll do for Christine is Christine works at Transamerica and she works with Athene. So Athene is my LLC. I do offer Athene annuities. There is one other Athene company. It's a big insurance company that they do insurance. Annuities is part of it. But I am not that large company. And she said that she was meeting with an employer to set up a retirement plan and wanted to know if there was any material to use to enhance her presentation. She's more than happy to use the handout because that handout covers all the top line things I talked about. And Christine, if you want, feel free to give me a buzz anytime.
Okay.
I
Good.
also work with Transamerica for life insurance and annuities, good company.
Yeah.
Okay.
This brings up another thought that I had is you were talking about 401ks earlier, and there are sometimes a limited number of choices that the
Yes.
employees have to select from, and the employer in shopping has to consider the administrative fees.
Yep.
But they should probably also consider, I guess, what the fees are for the basket of funds because sometimes those choices aren't as good as what would you say in as an extreme example, an index fund out with Vanguard or Fidelity or someone that has extremely low fees, and the choices are not necessarily as good. So how does employer do smart shopping, if you will, for a 401k administrator and plan?
So let's talk about this. These are some of my favorite things to talk about. So let's talk about fees. Everything has a fee because people have to get paid to do their job. Even index funds, passive funds, ETFs, whatever you call them, have fees. I used to be in marketing, and the thing that cracks me up is the big marketing thing was, no more mutual funds. They're actively managed. You're getting killed on fees. Well, actively managed is the key word. Those are mutual funds. There are actually teams actively managing that mutual fund. So first and foremost, if people were going to go bankrupt because they were paying fees, none of this would exist. The SEC, FINRA would have come down on everybody a long time ago. So when you have 401k plans, it's like having a fiduciary account with an advisor. You're going into what we call for just generally investment shares. They could be R3, R6, iShares. They have lower operating expenses than like an A or a C share that you would buy into in a brokerage account or on a DIY platform, right? So non-fiduciary type investing. So, my feeling is when I'm working with an employer and a TPA, of course, the fees are transparent. Those operating expenses, the underlying fees are transparent. But this is what I believe. We can certainly do a comparison and we will look at several different options, but you're rarely, if ever, going to see a huge disparity in fees, right? There's no perfect investment. So many people, again, like to talk about an index fund because it rides the benchmark. Well, that's all fine and good. You can ride the benchmark. You could say, oh, over time, I'm going to do fine. And obviously, being in the business, I have a bull mentality, right? I'm not going to be afraid of the market. But do I necessarily want my index fund to be all I have? Everything is in one basket. I'm kind of going into some other things, but it brings up some things I talk about a lot with clients. Do I want to take that 40% hit when the market's down 40%? Maybe if I have 7 different investments, they could all be index funds. It could be a mix of mutuals and index, right? It could be stocks and index funds and CDs, whatever. Maybe I don't get that 40% downturn, right? So when you're looking at a retirement plan, the big thing I like to, for my clients, everybody's different, is I believe in having a good variety without being overwhelming. So at least 15, at least different funds to go into, right? At least, and this is, we're going to have more than this. 5 fixed income, 5 growth funds, 5 value, 5 international, so people can choose. if you're just starting out, one fund family is fine, like an American Funds, but some people like to go with a platform that mixes. Maybe it's a little T. Rowe, maybe it's a little Vanguard, maybe it's a little American Funds, right? So many different companies in the mix. Typically all 401k plans are going to have a lifestyle fund, like a target date. So there's no perfect investment. Again, I tell my clients, have a wide selection of funds for your clients. The reality is, unfortunately, no matter how many times I meet with my clients' employees, so few of them will call me to get educated on the funds. I do hold at least one meeting annually, but so many of them are just going into the target date, which is not necessarily the devil, because a target date fund is a mix of equities and fixed income to supposedly meet your risk tolerance as you age, right? Hopefully
Well,
that helped.
It certainly does.
Good.
We haven't drawn any other questions from our participants, so I'm going to ask the last one. Your illustration about saving to a goal of $500,000,
Sure.
and you know, you showed that if you're starting out at 25 years old, you know, it's a much smaller number than obviously if you're back to 55 years old. But $500,000 in 40 years for that 25-year-old, that will, you know, that may not buy a restaurant meal. So shouldn't folks at a young age really try to be much more prudent and a little more aggressive on their savings?
Sure. So some rules of thumb, you know, always contribute to your employer's match. So if an employer is contributing 3, 4, 5, whatever it is, whether there's a vesting schedule or not, contribute that at least. And then the goal is always to max, always. So if you can max your 401k, you know, because you're over 50 at 30,000, I think it's 30,500 this year, 30,000 plus, find a way to do it. Find a way to do it. And if you can't, let's say you were doing $5,000 a year and you can't do the max. Let's use a large gap here. Well, do 10 grand a year. There are things out there. I've put some things up, you know, in your 30s, you should be doing 12%. You could use those numbers as an example, but the goal is always to max to the IRS max as soon as you can. Why? Because it's going to be out of your paycheck. You're not going to miss it, and you're going to adjust your spending 100%.
Good advice.
Yeah.
Well, Jenny, we appreciate your time today to
Sure.
get our business owners some insights into retirement planning. More questions develop later. What's the best way to reach you or your company?
You can email me at Jenny, Jenny, at AtheneWealth.com. You can also call me 860-430-2637 or find me on the web, AtheneWealth.com.
Very good. Thanks so
All right.
much.
Thanks so much. Okay.
As a reminder, this webinar was a presentation of the Community Economic Development Fund in Meriden, Connecticut, and for the 11th year in a row, we're Connecticut's top SBA microlender. We make business term loans at very nominal interest rates, as small as a few $1,000s, and larger business loans too, from a pool of loan capital provided by many of the state's leading banks. There are geographic and/or income qualification requirements for the borrowers, and you can find out more about all of this at cedf.com. We've recorded this presentation and will make it available in the coming days. You can find that and much more content on our educational website at weteachsuccess.org/replays. I'm Frederick Welk, and we thank you very much for joining us today.
Thank you. Bye-bye, everyone.